The only reason I bet big on Symbotic was because I have been at Amazon doing the robotics. So the thing is, you're not going to get any AI, pure play AI companies, at least for another 5 to 10 years. I've not been in the we won't have a recession camp. I've been on there's definitely going to be a recession. Don't know when. And it's going to hurt really badly for a lot of people. So you're going to hold crypto as a speculative value for quite a bit of time until it loses its value. But right now, speculatively, it's doing fairly well. People seem happy with it. But people that want to do day trading don't realize the amount of time, effort, energy, and the effort work that is required with the steep learning curve takes a year or 2 years. I mean, anything new I've started, if I've tried to be successful in it in less than 2 years, I've always set myself up for failure. So if you have a bearish view for too long a period of time, you're just wrong. The market is designed to go up. That's the whole point of the market.
Mukund, thanks for coming on the podcast. It's great to have you. Do you mind kind of giving the viewers a walkthrough of what it is you do and your background that led you to that a little bit?
Sure thing. Thanks for having me, Monty and Josh. I've been in technology actually for 30 years, and during that time, I also traded. So my background has been at Amazon. I was director of engineering at Amazon, director of engineering and technology at Microsoft. I've been at Cisco. I've been at HP. So I've been at larger companies, and I've also been at startups. So I had my own startup. 2008, I started a company called BuzzGain that I sold to a company called Meltwater in 2011. So I've started my own company in software, sold it, started a couple of companies actually, sold them, and also been in technology. But during that time, I've also been trading. And in the last 2.5 years, I focused more on the trading and training other traders. So I focus a lot of effort right now just on taking my portfolio that I've built over the last 25, 30 years or so. I do a combination of about 80% is just long term. I buy and keep it for about 3 to 5 years in secular growth technology companies. And then about 20% of my portfolio tends to be mostly just combination of swing trades and some of them in options. About 10% is options, 90% is just swing trades in my trading account. And then I spend a lot of time coaching and teaching a lot of proprietary traders, mostly folks that are doing swing trades, but also a lot of people that want to do day trading as well.
That's awesome. So when you say a technology background, was that like you said it was mostly the engineering side, or is that like a coding or
Coder.
specialization coder? Okay, that
Yeah,
is yeah.
that's how I started my career. My career in Cisco started as a developer, software developer. Stayed there, and then I was CTO. I was Chief Technology Officer of a company called Build Direct until 2020, 2021, where I ran their technology team. And this was an e-commerce company focused on the flooring space.
You probably have a much deeper perspective on the different aspects of technology, what goes into, like at Cisco, the network devices, what all technology and, what you can branch out to for potential investment ideas, like, the latest IPO ARM Holdings with their CPU technology going into semiconductors, going into network equipment. I mean, you can probably just kind of figure that out from an earlier perspective.
Yeah, so that's why I tend to stick to mostly tech, very little outside of tech. I maybe have 4 or 5 companies outside of tech that I've invested in. That's it. Four or five. Costco. I could name the ones that I have.
Don't get me started on Costco. It's my favorite.
Costco is because I go there so often. I'm like, yeah, this is a good company. I'm just buying it. Right?
Yeah.
Costco is one of them. Chipotle is another, right? Because I just go there so often. I'm like, oh, this is good food. I'm buying the stock. It's companies like those that I would invest in that are not technology. But within the technology space, since I know the market from a practitioner's perspective, I tend to pick and choose a little bit better than maybe someone who doesn't have that background.
I find that to be extremely unique because there was a research article that I read, and I should probably source it, but the gist of the research report was that typically those who have very technical backgrounds do not make very good traders or investors. And I don't know, they didn't come to a conclusion of what it was, but my assumption is that it's probably a combination of analysis paralysis, or becoming too being too informed can actually be detrimental. And then the research report was saying that people often with marketing backgrounds, or communications backgrounds, surprisingly, tend to actually make the best investors and traders, rather than those with those more what might think the more specialized, the better performer. Do you often run into situations like, let's say for AI, for instance, while everyone is excited about this brand new technology, you having a more experienced background looking at that and just saying, well, it's just a bunch of algorithms. I don't see the big deal there, because that's the gist I get often when I talk to people in the field that are really in tune to that or have experience in it. They seem to be a lot more nihilistic than those who are outside and everything's magical and fascinating to them. Like, have you run into some of that as well, or how do you find that balance?
Yeah, I do tend to miss some not so obvious moves. So for the AI trend, my biggest play, January of this year, I added a lot of NVIDIA at 179, 189. I've had NVIDIA since 2016. It hasn't done very well for me, but I just kept it. But I added quite a bit of NVIDIA in January of this year, and that's it. So I missed the move. The ticker symbol is AI. The name of the company is C3 AI. Totally don't believe them. I think they're a decent company, but they're not worth the hype. I missed the move in SMCI. I bought it much later, sold it much earlier, because I was not convinced 100% that this is a secular growth that is going to benefit SMCI as much. But they're doing very, very well. And I also didn't believe that AI is going to benefit some of the much smaller coming. So one of the biases I have is I will not touch any stock less than $2 billion.
Okay.
Market cap. I just will not touch them. Right. I've gone through too many experiences of these stocks that are small cap and low dollar stocks that I have no interest in them. So I missed out. I missed quite a few of the very small companies. And I'm perfectly happy with that for myself. The analysis paralysis part, I think the good thing is I have a math background with an engineering degree, right? So I look at it purely from a probability standpoint. And every time you see my post, so you'll find this, there's a 70% probability this is going to happen. There's a 30% probability this other thing is going to happen. So I think the thing that I've learned over the years is how do you position size well? When you are 70% or higher probability, you go in with a much bigger position size. Whereas if you're like close to 60, I'm not going to take a big risk. I'll take a small position. For example, with Symbotic, you and I talked about Symbotic quite a bit. I was pretty convinced, so I took a pretty big play with it. And remember the price as well, 1739 when you mentioned it to me, and we were both going back and forth on Twitter. I wrote it all the way to 56. It went up to 60 something. It came down to 56, and I sold all of it. Right. I still believe in the company. I still absolutely believe in the company, but the stock, what I've learned versus how the company does, you've got to be very attuned to that. And the probability of it going down was much higher than it going up at the $60 mark.
Yeah. Boy, you actually squeezed out more than I did on that one. It was a great trade though. Yeah, I think I got out a little bit earlier than that. I think it started in the 40s is when I started to unload that position, and I had some options in there as well. But yeah, that's a one where the hype just got too carried away as it went up. The risk just got too heavy. So yeah, I also took profits and got out of that one as well. So do you often touch IPOs then? Like, Monty mentioned ARM earlier. That's going to be over your 2 billion mark, or is that one where are you going to be more confident because of your background to step into a technology IPO like that? Or are you going to kind of just let that play out for a bit typically?
I was going to say one thing to Monty's point. Symbotic, Monty, the only reason I bet big on Symbotic was because I have been at Amazon doing the robotics associated with inbounding, start shipping, automated packaging, and pack pick ship, right? So I knew that something that required that amount of labor, if Symbotic can cut that down by 30%, and it did, and they had a huge backlog of earnings that they had already banked in from Walmart and Target. So that's one of the reasons I've been big on Symbotic. But back to the question you asked me, Josh, IPOs in general, I've changed my view over the last 7 years or so. ARM, I know it very well as a company, well enough to have been staying completely on the sidelines and expecting it to go down to 40 in about 6 months or even lower. In the long term, I'm a big believer that valuations play themselves out. They matter a lot. So ARM is just, in my mind, one person's opinion, ridiculously expensive. It should actually be a $26 to $32 stock, but a combination of no IPOs at all for the last, 6-8 months, or no big IPOs for the last 6-8 months. Kenvue is there, Kindle,
absolutely,
but there is lack of supply, so the demand went up. Even with Cart, Instacart, and the same with Klaviyo, I believe they're very good companies, both of them. Klaviyo more so than Instacart, and even more so than ARM. But the valuations are just too rich for me. ARM, I would buy if ARM was in the 26-32 range. I would buy Instacart if it was much, much lower in the 20 range, which is nearly 30% off of where it is right now. And Klaviyo, I think, is reasonably priced given its 62% growth year over year on revenue. It's a profitable company, very little spend relative to their peers on sales and marketing. So they have very good leverage, good, strong gross margins. 10 billion for a company like that, 9 point something billion is where they ended up, is reasonable. But I still think that there is a chance after, give it about 6 months, when the option and when the expiration happens for all of the insiders to start selling, I wouldn't be surprised if it goes down to the 6-7 billion range.
I'm not familiar. So for my radar for the IPOs was ARM, Cart, and then Birkenstock. I'm not even familiar with Klaviyo. Can you talk about what they do a little bit?
KVYO is the ticker symbol.
Okay.
KVYO. So in the CRM space, so if you look at it from the software as a service and cloud general space, there are two kinds of companies. There are infrastructure companies, like, for example, Datadog, Snowflake, Net, which is Cloudflare. And then there are applications companies like HubSpot, Salesforce, Klaviyo, etc. In the CRM space within the applications area, there are quite a few competitive companies that do fairly well, that are all in the same general space, kind of compete with each other, but the market is so big that they all do well. So Freshdesk, Klaviyo, Sprout Social, CXM, and CRM, they all kind of compete with each other at a very high level. But they're all in different spaces. Klaviyo focuses on Shopify customers. As a big bonus for them is that Shopify has invested in the company and also has a percentage stake in Klaviyo. So Klaviyo provides you with email marketing, text marketing solutions. If you're a small to medium-sized Shopify store owner and you want to be able to engage with your customers, to be able to provide ongoing promotions to help you with increasing your business, Klaviyo is a very simple, easy to use solution. There's a company that Intuit purchased a few years ago called MailChimp. Have you heard of MailChimp?
Yeah, absolutely.
So this is like a MailChimp, but focused on Shopify users. Built in 2012 is when they got started. They grew with Shopify significantly. They have a ton of customers and the hundreds of thousands of customers. Profitable company. And since they've raised money in Series B, they've never spent that money. They still have all that cash lying in the balance sheet. Plus, they raised some more in the IPO. And the founder, who's an ex-Harvard student, I think he started it when he was, I think he may have left Harvard and got out of it, and that's when he started it. Has run a very efficient sales and marketing machine. They've acquired customers in a very inexpensive fashion, very similar to a HubSpot.
Wow. So when you're evaluating a company like that, what is there a moat that you're looking for that also sets them apart from their competition?
I
Is there
think to
what?
be moat in the early stages of the company has to come primarily from technology. In the later stages of the company, for example, when the company is doing, close to about 5 billion in revenue, especially if it's a software company or a technology company, that's when you've got to look for other moats. But in the software space, moat comes from a combination of technology, unique capabilities, maybe patents to a certain extent, but also a lot of locked in customers, right? So anybody can have a partnership with Shopify, and they would probably want a lot of partners with Shopify. But there's only one company in the sales and marketing CRM space that Shopify has partnered with to be able to invest in them, and that is in Klaviyo. So that's one kind of a simple moat. I wouldn't call it a moat in the sense that how Warren Buffett defines a moat, but it's I don't foresee how another company would be interested, or Shopify would be interested in putting money in another company that competes with Klaviyo simply because it doesn't make any sense for them to do that. And then besides that, they have a ton of customers. The it's very, very difficult to move. I mean, you used what do you use for email connections with your customers and consumers? Do you use something like a Substack or?
Uh,
I use a Substack personally.
Yeah,
yeah.
okay.
And then
You
I'm just emailing or using Discord for most of my communication. So just
okay?
using
So
it.
take Discord as an example, or take Substack. It's technically very easy to move away from Discord and very easy to move away from Substack. There are alternatives, but damn, it's a lot of work. And given so many other things in your life, you're not going to change. Right? People get upset with, oh man, Substack is increasing the fee by 2% or 1%, or they're doing this, they're doing that. They never move out. The number of percentage of people that move out once they've got into something is very low. Technology has this sticky element to it because of the inertia, not so much from the fact that I don't want to do it. I've got so many other things in my life I have to do, and now this is going to cause another, certain amount of time to get done. I'm not doing it. Klaviyo, from a business standpoint, is very sticky that way. CRM is primarily your interface with customers, customer relationship management solutions. Once customers get used to it, your team gets used to it, nobody moves out of that.
Yeah.
Absolutely. And I was talking to Josh about this the other day, how I just got done building just a basic web page, and, considering on your note on Substack, moving in and out of the platform, you're also utilizing a trusted platform that when you see that email from Substack, you know that you can trust that email, you can trust a link instead of, random domain that you may or may not have heard of, that you may be cautious on, exploring further to get that information.
Yeah. Well, and then the familiarity that's also built over time. I mean, you take so much for, even if there's mistakes that they make with Shopify, it's gonna take so many mistakes for them to make before someone actually transitions away. I know with like Microsoft Cloud services that they provide, not the same, it's not a CRM, but they have so many issues or outages and problems that they have with companies, but everyone's like, well, it was only down for 5 minutes and there's tons of issues, but it's so much hassle to move to someone else that even if the service is not stupendous and 100%, it's just there's only two other players you can go to. It's such a hassle. You're already familiar with what you're working with. Why would you move? That's one of the things that if you read like reviews, they're awful, but then when you think about why don't they move away, it's usually something correlated to that. I do want to ask you about this. I'm staring at the ticker now, and I've already forgotten how the company name, the KVYO, Clove. Is that what? Klaviyo. Is there any companies like Klaviyo that are really standing out to you right now that are piquing your interest, or that have made it into your portfolio, or any future IPOs like Discord or maybe Stripe hits your technology background that you're excited about in the future?
Yeah, the companies that are piquing my interest, that are not yet IPO, coming in from the technology space, they're going to be quite a. So the thing is, you're not going to get any AI, pure play AI companies, at least for another 5 to 10 years, at least at the very minimum, right? At the minimum 5 years, most likely closer to 10 years. The average age of the company going IPO over the last 20 years have moved from about 5.7 years to 7.9 years. So that means companies are older, they're taking longer to go IPO. So any company started in the last 1 year, which is when truly the generative AI uh, space has blossomed, is going to take another 5 to 10 years to come up. So I'm not looking at AI companies coming out for me in the next few years that are pure play AI. In the meanwhile, there are uh, NVIDIA is an example, SMCI is an example, Palantir is an example. There are companies use a lot of AI in able. Lycan is good, written by one of the people that runs a venture firm called NFX. I don't know if you guys have ever heard of it. NFX is NFX. It's called Network Effects. NFX. The reason I know them is because the founder also started Trulia, which is a real estate technology company that he sold to Zillow. And written was there are multiple layers of the AI stack. There's the infrastructure layer at the bottom, and then there's the layer that allows you to be able to build learning algorithms and language learning mechanisms, language learning methods. And then above and beyond that, you have applications. There are a lot of companies on the application layer that are already public right now that can leverage AI to do a much better job of helping their business grow faster. Meta is an example of one company. To me, they're building their own Llama LLM equivalent variant, but they're also using AI in a significant way to make their ads better, to serve up more relevant content for Instagram users, for example. Companies like that are on the application layer using AI, there are quite a few companies that I think would benefit a lot. HubSpot is another one. In terms of new IPOs, I was looking forward to, actually Visa had acquired a company called Plaid. Have you heard of that?
I am, but it's not gonna. I've heard. I'm familiar with the brand name, but I don't think I can recall what they do.
So if you go to a lot of the fintech companies like SoFi, or even a bank, or even any other third-party broker, and you want to connect your bank account to this new company to be able to transfer money, it in the traditional place, you'll have to enter your account number, you'll have to enter your routing number, and then they put a small deposit of like 10 cents, 20 cents twice, and then they'll ask you to confirm it. Big pain, takes 3, 4 days. With Plaid, you enter your user ID password and it automatically connects literally within minutes or seconds, if you will. That's what Plaid does. So the infrastructure to help you connect accounts together, right? As one thing, that's one of the things that it does. Plaid was actually it was supposed to be acquired by Visa, the company that provides you the infrastructure for being able to do payments. And then Visa said no, because FTC said, hey, what are you doing? You shouldn't be doing this. So Plaid, to me, more than Stripe, is a very interesting company for me to look about that investing them in if and when they go public, right? Stripe is going to be very richly valued when it comes out, and there's going to be a lot of hype on it. So usually the well-hyped stocks, for example, if you look at the class of 2020, 2021, there was a ton of IPOs during that time. Airbnb, Snowflake, a little bit before that was Uber, DoorDash, Coupang. The valuations on all those companies was so rich. Even now, they're digesting their valuation, although their revenue has gone up nearly 3 times or 2 times compared to where they were before. Profitability is much better. Valuation matters. I think I wouldn't expect any of those companies to come with a low valuation. I would like a company with a medium to low down, like Symbotic, for example, came out as a SPAC. Valuation just cratered, got ignored, and then now I think it is on a rise. Man, look at a company that I really liked, which I think is going to take a little bit of time. There are two companies that I really like. They're not IPOs, but they're recent. Evolve is one, EVOLV. EVLV is a ticker symbol. EVLV. I really like the company. Good, strong play. They provide security for sports stadiums and events. So instead of you having to go through the TSA pre-check kind of an environment, you hold up your hands and you do a bunch of different stuff and you go through all the metal detector. These guys focus primarily on making sure that you get into events faster. So sports events, concerts, you can walk through very, very quickly, and they will detect certain things that they're looking for. They're not 100%. They don't detect any metal, but they detect guns. They are looking to detect knives. So schools are using them extensively to screen kids before they go into class and look for guns and things of that nature. EVLV is a ticker symbol. I like that company. I think it's going to take a little while. It's still small capish for me, so I'm not going to buy into it yet, but I like it a lot. I'm going to watch it for quite a while. And another company is ALUR. The ticker symbol is ALUR, which is a obesity company. So it's not perfectly in my technology space, but what they do is they give you a balloon. So you swallow a little pill, and it's a balloon that sits in your stomach, reduces the amount of food that you eat, and of course it later on passes by. It's primarily sold through doctors and practitioners to help people with obesity. Growing very well, revenue is solid. Again, got hammered. Just like it's going to be a while, people realize this company, and then it's going to start moving up into the right again. But it's going to take a while. Those are the ones that interest me quite a bit. The ones that have been beaten down quite a bit, but I'm going to wait and be patient for them to really prove over a tough period. And they're going to consolidate. It's going to be stage one consolidation for both of these stocks for quite a while. Their revenue is growth is extremely strong. Evolve has grown like 100%, literally every quarter over the last 3-4 quarters.
That's impressive. Okay. So, I mean, I'd have to look into those, but typically what I do with smaller companies like that is I tend to really overvalue that. Are they profitable? Is Evolve profitable? I mean, I'm going to have to do my own research, but
Evolve is not, neither is Allure, but I think they'll get there in a year. I think 2024 end, not 2023. So next year.
Quick. It's pretty quick. Yeah. That's great.
They're growing dramatically. They're growing really fast. And they have a combination of hardware and software. And they moved from a hardware only 30% margins, and now they have a combination of software, which is subscription software service. So their margins, their blended margin will grow up closer to the 40-50% range. The software comes in at an 80% margin range. The hardware comes in at a 20% margin range. So the blended, they'll go up a little bit more, I think. But strong company, good company. I think this is going to be a keeper, but it's going to take a while for them to prove itself out.
It seems to be pretty common in the tech space where you kind of, I don't want to say give the hardware away for free, or you're giving away at a low margin, but the subscription service, the licensing services that these tech companies offer on their software, that seems to be the real money maker, the recurring revenue, the growth aspect to it.
Yeah, so if you look at, remember Peloton, that one gives me scares sometimes, but I wrote it all the way. I wrote it all the way up during the COVID boom, sold it early enough, luckily. But yeah, the hardware, draw them in with hardware, keep them with a high margin software for long, is a standard play for most of these tech companies, who are in the hardware kind of software space. Hardware is hard. There's a reason why it is that way. There are very few companies like the Nest and the Ring that can make money on hardware and do it at scale. That's only if everybody wants it. But a company like, for example, Evolve, where this is a schools, stadiums, maybe some offices where they need it, it's going to be tough to be able to sell a high margin hardware unit.
No, absolutely. I got 2 notes on that. The first is, Roku just got into that hardware business with the home security, the smart home stuff this last year. So that might be a interesting one to start looking at a put position for. And then the other one was, I'm pretty salty on Peloton. I remember reading an article in the journal. It was like right around December when they cut their subscription fees. And that's when I knew, okay, it is time to short this position. I was working at a value firm. I needed all my trades approved. and they looked at me like I was crazy whenever I suggested a tech company. So I'm still kicking myself to this day for not writing that one all the way down.
That one was a disaster in particular. But do you often short stocks? Or are you all long only then? Are you playing both ways, or and how much option trading are you doing? I know you do a lot of teaching to traders, even some professional traders. You hinted at proprietary traders.
20% of my trades are short, 80%
Okay.
is long, right?
Okay.
And back to this, 80% of my trades are swing, 20% of my trades will tend to be more short term, and the 20% is entirely in options. So when I say swing, for me, usually it's about a week to about 2 to 3 weeks sometimes. And I like three patterns that I love that I just find repeatability in again and again and again. Post earnings, huge gap up, green, beautiful, lovely candle, consolidates, creates a bear flag, creates a bull flag, creates a bull pennant, and I know it's going to go up. So that's a comfortable play for me that consistently comes up. Then the second play I like is a company, for example, that I've known for a long time that I believe the market hasn't understood why and how the company is doing badly because of a whole bunch of reasons. For example, I bought Sentinel One after the previous earnings at 1302, 1268, 1292, bunch of different prices then. S is the ticker symbol, Sentinel One, sold the.
Oh, I think we're having
we
some pretty
lost him,
bad
yeah.
connection issues.
For an entry. I'm not convinced that be a good entry yet. It's still moving back and forth, but Zoom Info would be one that I would look at. And then another one I'm looking for an entry that I like as a company is Chewy, but I wrote it down. I wrote it down very nicely, but I'm still waiting. I'm going to have to be patient with them. And so I did a short on Chewy, but on Chewy, I think this might be it. So that's the second play, which is the company fairly well. You're still not sure why the market doesn't get it, but it takes its own time, right? You don't want to get into the situation with, for example, Zoom Info. You could have bought it at that's just recent earnings. It went down from about the 20s down to 17 or the 18s, and it's still going lower and lower and lower. There's no, you don't want to catch a falling knife. You want to wait for the reversal. You want to confirm the uptrend, and it breaks through at least two what I would call previous resistance positions. So that's my second play that I really love. Two resistance positions, yes, I'm in. I know that it's going to go for I want a failed breakout, come back in again, and then bridge through two failed positions, and then I move back in again. Those are the plays I like. In terms of options, I just look for simple consolidation by volume, consistent, and I play it for less than 3 months. So my lookout would be for a week. I've never played a zero DTE option yet. I'm not. I don't enjoy those.
I just read they're 50% of the S&P's option volume now.
That's
reported by JP Morgan.
That's surprising, isn't it?
That's crazy.
It's absolutely egregious. Like, you're flipping a coin. Am I going to make money or lose money today?
And the Wall Street Journal did an article. Apparently, there's millions of these people that just do that.
Mm-hmm.
Yeah.
But they're just rolling the dice. But I guess somebody's got to do it to create the.
And it doesn't get picked up on the VIX, so it's keeping our volatility index suppressed.
My suspicion is a lot of that is very small transactions, maybe 10 contracts and lower. So I don't think they move the needle significantly enough. So the percentage of transactions may be high, but the volume in terms of the dollar impact may not be that high.
That sounds reasonable.
Is the historical data for that still relatively high? Because I remember it used to be like in 2020, it was, insane amounts of option trading, and I feel like that's come down a little bit. But is that still relatively high? I haven't looked at the data. Are you aware of that, Monty, by chance?
I haven't seen any reports on it in the last couple months, but I know it's come down, but it's not completely dissipated. It's still pretty up there.
Okay.
Well, look at it relative to before 2020, right? it's up 3x since 2019.
Yeah.
So if it is down from 4x 2020 to 3x, it's still up 3 times.
I wonder if the bubble isn't truly popped until we see that normalize again.
I think once 0-day options are out of the picture, that's when the bubbles popped.
Yeah, when a lot of those speculators are finally burned out. I think we've burned them out of crypto. Do you ever look at crypto, Mukund, or is
Yeah,
that
since 2015, bought a bunch of
early?
Bitcoin, bought a bunch of Ethereum, left it alone. Haven't touched it. Air gapped, kept left it alone. Rode the
Yeah.
high, rode the low, and then I do a lot of trading on crypto when I find good entries. For example, beginning of the year, somewhere around the 21K, sold it at 26. It was at 18. I should have bought it at 18, but 21 was a decent enough price. Sold a bunch of Bitcoin. I only stick to 2 or 3. I only stick to Bitcoin, Ethereum. Once in a while, I might go into Solana, but that's it. I don't do altcoins. I don't do ICOs. I don't do any of the other stuff.
It's too much. At least personally, I find there's too much time that you have to invest to learn about all these new coins. I remember, and I was late. I was so late. Everyone I talked to, they were so early. I'm like, wow, I was definitely part of the crowd for the crypto train. But I find that it takes so much time. The people constantly ask me, I'm like, I can't possibly study these 200 different altcoins when 99.9% of them are just, they're garbage. I mean, there's no point in even learning about it. You want me to dig through this? I just can't even put the time and effort to try and pick out winners of that. It's just such a, I need ChatGPT to do it for me at this point. At least set some parameters for to help me out. Shift through that noise is I mean, even now is still so strong. Is my feeling.
I think the best strategy, Josh, you create a really cool logo, write a BS business plan, ICO, and move out to the Caymans.
Yeah. I mean,
by the way, Monty, you're not too far away from the truth. That's exactly what happened in 2018, I think 2018 to 2020. People would print out ICO prospectus, very similar to IPO prospectus, say a bunch of words. I don't know if you remember Nikola, which is the company.
Oh yeah.
ALA is a ticker symbol. The guy said, like, we are using HTML5 something on the truck, or that's why we are unique. That's a bunch of BS. You could smell that from a mile and say, I'm shorting it, right? Similar to that on the ICO world, a ton of nonsense. You just want to, it's an easy avoid. A lot of them are an easy avoid. But Josh, you mentioned 99% of them are garbage. Unsurprisingly, of the 8,000 stocks that are listed on NASDAQ NYSE, I would also posture that 95% of them are garbage.
yeah. I
Garbage
mean, you're not wrong.
is garbage stock, right? You shouldn't be touching them. They're just there purely for speculation. And once in a while, you might get a company that is like a Celsius that is really come down from where it was and consistent, steady growth. But 95% of it is just garbage.
Yeah, I wish I had the stat for the number of zombie companies out there right now. And, I'm just hoping that these higher for longer rates wash a lot of that stuff out in the next year or two.
The higher for longer is going to create a lot more hurt than a lot of us are anticipating, I think. It's going to be very hurtful. I've never, since the last 2 months, or since June, actually, a little bit more than that, I've not been in the we won't have a recession camp. I've been on there's definitely going to be a recession, don't know when, and it's going to hurt really badly for a lot of people, given that it's going to be recessionary. Unemployment is going to go up pretty significantly from where it is right now, given that we have historically very low unemployment rate. And on top of that, you're going to find a lot of people hurt even from the downturn in the mortgage market, well, in the housing market. That's going to go down a little bit as well. People won't move, so inventory will be low, but house prices are going to come down.
Yeah.
Oh, absolutely. If not, already starting with. with mortgages being valued higher than the actual homes. It's absolutely nuts out there in the real estate market.
Yeah, I
Just
feel
imagine you're having the housing challenge. People that used to pay $1,000, $1,200 for a mortgage now are paying nearly two times that. You're going back to student loans, people that would get $300, $500 a month to be able to keep as a cushion or spend it, that's going away too. And then I don't think the impact from higher oil is going to be that significant because a combination of factors. I think the move from a lot of shale drillers will keep prices still reasonably okay. I think it's going to be close to 100, but it's not going to be 150, 200 like a lot of people are expecting. And then, of course, the unknown is this. The short term is the government shutdown. I think that'll work itself through, whether it's shut down for short term. I don't think I'm not too worried about the shutdown issue, but I think I'm definitely still not. There's still an asterisk on this whole war, Russia, Crimea thing. Nobody knows where that's going to end up. It's been going on for what, a year and a half, and still we don't have any clue if this is going to end anytime soon, and what impact will it have? And we're still bumbling through it on an ongoing basis. No, nobody's to blame necessarily, except for the people that are involved in the war.
Oh,
yeah.
absolutely. It seems like it's such a slow crawl. I've seen it in the news every day for the last year and a half, and it seems like there's just been hardly any movement in the war, no progression, just a couple treaties and agreements broken, like the Black Sea Agreement was broken by Russia. What was that, a month or two ago? So you can expect your potash prices to go up. You can expect your wheat and corn and other grain prices to go up. And with higher oil, higher nitrogen, fertilizer is probably going to be more expensive. So what are your thoughts on inflation relating to that? So we have higher oil prices. We're potentially going to have even higher food prices. You have the United Auto Workers strike continuing, and there could potentially be less vehicles being produced over the next couple months to a year. I mean, where do you see inflation going from here on?
I think the way I thought about was inflation was the three levels or three phases of inflation, right? The first inflation was purely because of supply chain constraints. The second wave of inflation happened when Russia and the oil issues came about. And then the third, food inflation, happened when, again, wheat primarily, but other food products as well from Ukraine and the rest of the places around Russia started being much harder to get out of the blockage of the food going out, right? The new level of inflation, I think, is going to come from higher wages. Companies are going to pass higher wage costs all the way from simple like UPS paying higher to California now passing a $22 minimum wage for restaurant workers, to UAW, to the actor and the screenwriters guild strike getting much higher wages. Wage inflation will happen. Not a bad thing for a lot of people who are going to have to need that money to be able to stay afloat. But all of this is going to create another round of inflation, I think. Um, Higher oil prices does cause inflation, but I think that would resolve itself a little bit over time. The moment I've always seen this magic price of 113, the moment oil prices seem to hit 113, you get a bunch of people starting off in Texas and a bunch of drillers starting out in Kansas that have never wanted to do it, right? The moment it comes up, they're like, let's start drilling again, right? So I think oil prices, yes, there is an overhang, but the effect of oil prices, in my opinion, on inflation is going to be not that significant. Supply chains are ebbing to a large extent. They're getting back to normal. The problem we had was just way too much demand, which to a certain extent has resolved itself, but supply, just a lot more supply, has resolved the issue more than anything else. And that'll continue to happen. So I don't think inflation, where I think inflation, the fourth range of inflation or wave of inflation is going to come from higher wage prices. But technology overall is disinflationary, right? So you're going to find one of the challenges, I think, very small segment of the employment market is the technology, people that work in technology. That has actually been on a downtrend. The number of people employed in technology, not just Meta, which laid off a lot of people, Amazon, which laid off a lot of people, and a bunch of other technology companies that laid off quite a few people. I think the rest of the folks because of the optimization with AI over the next 2 to 3 years, that's going to create disinflation as well. It will
Yeah, I
increase.
remember. Sorry, I was going to say, I remember reading a LinkedIn article that the layoffs from these tech firms, I think it was in the last year or 2 years, it was actually more severe than what we saw during the dot-com bubble.
Well, you have to, the reason, if you keep it in perspective, they overhired during COVID, right? So 2018 staff versus 2021 staff, Meta, Salesforce, Microsoft, Google, Amazon, maybe not Apple because they didn't overhire. All these companies, their headcount went up dramatically. Relative to that, they laid off a bunch of different people. But a lot of people that they laid off were people that they hired during the COVID boom, and they expected the boom to continue to a large extent, right? So yeah, they did have a lot more layoffs in pure numbers than the 2008 2008 mortgage crisis. But I still think the worst is yet to come. It's going to get a little bit more difficult in technology, then it's going to get better. Not in terms of the companies doing well, but in terms of employment in the sector. I still think Microsoft, Amazon, Google, all the other companies will do well as a company. Profitability will increase, revenue will go up, maybe not as much as they did before, but they're going to employ fewer people.
So I have a question relating to technology while we're still kind of on the topic of inflation and geopolitics. So I think it was just last week I saw an article in the Wall Street Journal that China is starting to become a little bit more aggressive in their military training. And one of the aspects that they noted was that they didn't really announce it to Taiwan that they were going to be running these drills. They just kind of ran them. So it wasn't necessarily like a PR type of deal, like, hey, we're capable of doing this. It's more, we're just going to do it. And then the United States was moving a couple drone ships out that way. So kind of on that topic, going back to ARM, going back to the semiconductor industry, do you see any problems arising in the near future, or if there were an event to happen in the South China Sea, do you see anything arising in that space?
I'm not as well versed in politics, especially China politics, as other people, right? So I don't have very well formed opinions. So I'm going to speak at it more from a rational thinking perspective, which may not be the right way to do it. I don't think China is going to cut the nose to spite the face. So I don't think they're going to do anything in the short term with Taiwan, which might hurt them more than it hurts. It will hurt everybody, but it'll hurt them the most. They already have a lot of challenges with their real estate challenges, with their reopening challenges, but I think those will also work themselves out over the next 3 to 5 years. So I don't expect China to come back and say, oh, we're going to be in this Japanese 10-year downturn kind of. I think they will act a little bit more sooner towards that. But I think the investments in the US semiconductor, specifically manufacturing sector, which the government has put money forth, whether it's Intel building the chip factories, TSM, Taiwan Semiconductor, building another chip factory in the US, or diversifying into building them in Japan, which they seem to really like, or Germany, which they've started with TSM. I think those might be the only ways to be able to diversify from depending on Taiwan, China for a lot of the semiconductor. Still, packaging is still then. Most of the packaging in the semiconductor space, the design is done in the US to a large extent. The assembly is done to a certain extent. Building is done in Korea and Taiwan. The assembly and packaging is still done in China, right? So they still have to diversify away from that. But packaging is going to go to probably Vietnam and places in Southeast Asia, not back to the US. The US is still going to do fab, which is not packaging, right? They're two different things. Packaging involves a lot of manual labor that still requires dexterity and skill. in the semiconductor space. So I think that will go to probably some place like Vietnam, to a certain extent, maybe India, but not as much. But a lot of it is going to go to Thailand, Vietnam, places like those in Southeast Asia, Malaysia, whereas the fab, at least the start of it, is happening in Phoenix and a few places in the US, Germany, and Japan.
Yeah, the one company that it's been a couple years since I've really taken a look at them, but Amcor, I think they had the lowest presence in testing and packaging coming out of China. So they might be a good one to revisit and investigate on that. But one of the biggest questions that comes up for me when, considering all these foundries being built across the United States isn't necessarily erecting them and, getting all the semiconductor equipment put in place or manufacturing equipment, but more so who's going to staff these factories. This has been out of the United States for what, 20, 30 plus years, and we just don't have the talent. We might have the people to be able to train to do it, but we don't have just people to be able to step in and get to work yet. I mean, how are we supposed to address this? I mean, that might not be a you question, but
I'm going to give you a controversial opinion, and this is my opinion alone, formed just in my observations. And my opinion is that's one of the big reasons why you're going to find some solution to so many Colombians and Venezuelans migrating to the US, being given some kind of a work permit, work visa, with an ability to be able to get moving into being a citizen at some point in time. I think that's going to happen. You're going to find much higher immigration in the US because the US, say what you will, regardless of what people think, the US tends to be very rational. Yeah, we fight in the middle for a little bit, but we're one of the smartest countries in figuring out where the need exists, and we will fight and fight and fight, and then we'll get it done. Right? I still think you're going to find that immigrants are going to, first generation immigrants, primarily from maybe the Central American countries, maybe some of the North South American countries like Colombia, Venezuela, immigrants coming in from there, they're going to fill that gap, because a lot of Americans who lived in the US for a long time are going to find it much harder to do those jobs, having been given good labor jobs with good work pay. The skill that is required is more of a younger person's job. Most of the young people want to be social media influencers, man. They don't want to do the amount of skill and dexterity that is required to do those kinds of jobs. I think you're going to find a lot of immigrants are more than happy to do it. And they would probably, I don't know, a couple of days ago, I think it was announced, or maybe a day ago, that they're going to let the Venezuelans or the Colombians who moved in, about 500,000 of them, start to work, give them work permits and start to work. You're going to find they're going to fill that gap. They're going to fill that gap more than anybody else.
That sounds reasonable.
I agree with that. We've also heard a lot of in the debates leading up to the elections that the different candidates have, a lot of them have spoken to immigration and different merit-based immigration to try and get to fast track as many of those as possible to get more workers in. So I think it's already, we've heard some discussion of that being a major goal as well. So I agree with your opinion a lot right there. What were you going to say,
Find immigration, there are multiple types, right? You want the very educated, young, but at the same time, you also want the willing to work, hungry, maybe not as educated, but willing to put in the hours. You want both of those. You don't want to be able to have it in such a way that you're only getting talented software engineers or something like that. That's going to be a skewed environment. You also need the people that are willing to work in the fabs and the factories, people that are willing to work with their hands and their feet.
Yeah, absolutely. Monty, I interrupted you. Were you?
No. I was potentially going to segue over to metals to see if you had any opinions on sourcing materials for building semiconductors out here in the United States. If that's going to make a difference in supply chains compared to here versus Taiwan, or if that's something you're fluent in.
I think the biggest source of rare earths is still China, right now. There are a couple of companies. Have you heard of MP Materials? Ticker
I
symbol is
have not.
E.
Is
MP is the ticker symbol. MP Materials, I think they're either in Vegas or somewhere over there. So we do have a couple of companies that do some rare earth metals and mining and refining here in the US, but still significant, if not 80%, maybe close to it, comes from China. And they're going to control that, I think, to a large extent. The US has a lot of rare earths. We just don't want to mine it for a whole host of reasons, environmental reasons, a bunch of different reasons. I'm sure there are some employment reasons as well. Whereas I'm not very familiar with the rest of the metals. I focus purely on the rare earths because they're very important to the semiconductor industry, as opposed to mining all the other stuff like bauxite for aluminum and everything else. I don't follow that copper. I don't follow that as much as the rare earths. Rare earths, China has a dominant position. Malaysia and Australia have some deposits, but the US has the largest untapped deposits, which I suspect, if push comes to shove, the US will get there, right? If push comes to shove and China suddenly says we're not going to export it, Japan's going to suffer a little bit, but I think the US will say, okay, all right, we're going to start mining our own. We have a lot of deposits. We just haven't mined them. We haven't found the need to do it. Very similar to one of the largest deposits of oil are Canada and US. We've just not wanted to get into tap into those for a lot of reasons. Besides the fact that we want to avoid people depending on oil as a fossil fuel source of energy, causing more, greenhouse gases, if you will.
Yeah, I like how you put it to where, it sounds like the United States are kind of, keeping our materials close to the chest, going out elsewhere to source. And then if there were potentially a big geopolitical challenge, we have these reserves still in our backyard that we could exploit to, stay afloat instead of, potentially run into bigger challenges from a geopolitical problem.
It's the same thing that happened in the 70s with oil. When suddenly oil got difficult, we said, okay, all right, you guys are going to throw your weight around. We're going to drill our own oil, right? We have a lot. This country is amazing at figuring out, okay, if this is the problem, we're going to solve the problem. Again, we fight a lot and get through it. And there are opinions on either side of the spectrum, but eventually we get it done. Very similar to why you needed that whole COVID boost that came in 2020 when people were given checks, right? Yeah, people fought over how much should you give? Should you give a lot of money, less money, you shouldn't give money? And then we got it done. And I think that has pushed off this recessionary environment for quite a bit of time. Of course, the jury's still out. In probably 5 years, we'll come back and say, that's probably not the smartest thing we could have done. We could have done it better, but who the hell knows? But it has given us some short-term benefits, which is untenable.
Yeah, it's kind of challenging to, when you're in the heat of the moment to really assess the long-term damages. It's a last-minute power play, and yeah, sure, you can analyze it, assess it later on, and figure out, well, we could have done this, we could have done that, or done nothing at all. And it's easier to, hindsight's 2020 at the end of the day. But kind of touching up on that, touching up on the total economy, touching up on where inflation's been and where it's potentially going. One of my biggest concerns revolves around the consumer. A lot of the lower end consumers, or actually consumers across all income spectrums, it seems that they're more heavily reliant on utilizing credit cards or lending to cover their bills and expenses on a monthly basis. And as we see this trend continuing, it appears that personal savings has essentially depleted from that little bit of a spurt we got during the couple stimulus checks. So my big concern is that the consumer is starting to feel kind of stressed and strained on an income perspective, becoming more dependent on credit. And considering a lot of the fintech firms, they cater to the lower end consumer. Do you see any issues in personal consumption and, these fintech banking firms, or, even small regional banks, or anything relating to that?
Yeah, I think you're going to find the consumer that led you and I and everybody else that led us through the last year and a half. High inflation, we still spent money. We took our vacations, we ate our food, we went to restaurants, we did revenge travel, whatever the heck that means. Did all of that.
Is that like when you get divorced and still go on the trip or something, or?
I have no. I think that was, you're locked in for so long that you just wanted to go out, and
Yes.
I don't know.
Yeah.
I think the consumer is going to find it challenging for the next year and a half. For a lot, well, the simple consumer equation is you make enough money and you spend enough money, and then you borrow the remaining, right? Now, because of inflation, we've put a lot of we put a lot of effort into raising interest rates to a significant enough level. And when you do that, you're going to find one or two things happen. Either they say, okay, things are costing, the two biggest things that the US consumers spend money on is number one, housing. Number two, most people would think it is food, but it's not food. It's actually automobile. Going around places, whether it's an auto loan plus gas plus maintenance, the number two spend for US consumer is automobile. So if gas prices keep going up, plus the UAW strike, the average new car, which used to cost 20 something or $18,000, is now 24. It's going to be harder for people. What used to take 33 months to pay off your car loan is now 46 months. You're going to find that to be tightening. And on top of that, the number three thing they spend money on is student loans. Well, loans of any kind. And which is why you're seeing the highest number of delinquencies in credit card payments since 29, I think 2008, 2009, I think is the highest. So you're going to
Coming up.
Yeah, you're going to find it more challenging for the consumer for the next, at least I would say 2 years, not for the next 6 months or so. It's going to be 2 years of really tough environment. We haven't felt the pain so far, but some people have felt the pain. The next 2 years is going to be a little bit more tougher, I think, overall from a consumer perspective, which is why I believe it might be a little bit more recessionary. But recessions don't last a long time, right? The average on the market cycle, the recession lasts about 12 to 14 months. On the economic cycle, it lasts maybe 3 quarters at most, right? A recession is typically 2 quarters of negative GDP growth, technical recession definition. So by the third quarter, people, okay, all right, come on, we're already in recession. Inflation is high, but we're in a recession. Let's try and find a way to get out of this. My suspicion is they'll get to that point fairly quickly.
Yeah, so I'm pretty fresh on putting out analysis on Square or Block, ticker SQ, and that's been something that's been top of my mind for quite some time, but especially more recently with credit card delinquencies, especially relating to these fintech firms. Do you think it's going to be a slow burn, or are there going to be signs writing in the sand, something that will kind of be an indicator of this is the collapse, it is happening right now? Or do you think it's going to be like a slow trickle over the next 2 years that we'll experience?
I don't know the perfect indicator, but I suspect a bunch of different indicators are going to tell us that it's not going to collapse right away. I think the indicators are going to tell us we're going to have one wheel breakdown at a time. It's not going to be the whole car blows up. It's going to be one wheel at a time, one little part here, a widget there, a little rotor there, slowly comes off a little bit until it takes time for you to replace it and then start moving again. So I don't expect it in the Block scenario, particularly. Block make most of its money with merchant transactions, right? The consumer side of the business, which they've now started, not now, I'd say 2-3 years ago, they started moving up, has been relatively recent, but it's only about 30-40% of their business. And of the 30-40%, remember, a big part of it came from crypto trading. Everybody and their uncle got into crypto trading. Block allowed consumers to get into crypto trading as well. And so that boosted revenue in the short term, 2021, 2020. and then now that has come back to normal levels or even lower than normal levels. But Block, I think, makes more money from merchant transaction swipe fees than it does from consumers. The consumer side of the business also is good, but not as big as the merchant side. In the consumer side of the business, which is the reason why I was not even bullish on UPST. Have you guys followed the ticker Upstart?
A little bit. I've
No.
traded it a lot, but it's been
That is one company that makes personal loans. They make personal loans to a large extent. They put it on their own books. We sell some of it. I'm not bullish on that company. I think you're going to find them finding it extremely hard to give out loans, which is why I think it's going to take a while for a lot of these fintech players, Block, SoFi, Upstart. They're going to find it tough for the next couple of years, I think, at least.
Yeah, and the way what my mentality is on Block, especially a lot of these other, kind of integrated fintechs, is that, it's going to kind of create a cascading effect to where, one of their business units, primarily the consumer, is going to inevitably affect the small business side of commerce. It's going to affect the business lending. It's going to affect their transactionary revenues. It's going to kind of just reach into the different business units of Square, and potentially, especially affecting that cryptocurrency trading. That's just my perspective on it.
When we're talking about all these factors of inflation and money printing, and you've already expressed your interest in cryptocurrencies, albeit the few big players, which I think is smart. Do you see the future that many profess, of a switch to either some sort of gold-based system where Bitcoin is the replacement, or a currency replacement with the dollar to Ethereum? Or are any of those scenarios playing out, in your opinion, or even viable? Or is that not even your investment thesis for buying those? Or is that still just like speculation? Where do you categorizing that right now in your mind?
If I look at the three use cases of crypto: store of value, number one; transactional currency, number two; and number three, utility. Those are the three uses of money, if you will, right? An equivalent of money. Gold has been a store of value, which means that if you want something to hold its value or go up slightly during times when everything else is going down, you put money in that. So gold, you buy gold, keep it, store its value, because you have something physical to hold on to, right? The second one is transactional value, which is primarily using it for bartering. Hey, you don't know the price of that. I don't know the price of this. You want this, I want that. Let's come to a medium where both of us can say, okay, I'm going to give you this for this thing that costs the same as you have 5 dogs, I have 4 cats. You want to do an exchange. Well, how much is a dog? How much is a cat? Let's put a value on it, right? That's transactional value of transactional notion. And third one is utility, just purely the means of being able to say, I'm going to exchange, right? My thesis has always not been it's a store of value. My thesis has been that it's more of a purely speculative move than anything else. And eventually, if it gets enough regulatory buy-in, you will find people using it for multiple use cases. Until then, which it has a lot of naysayers still. I mean, it's been what, 2008, so 15 years.
Yeah,
Bitcoin and Ethereum have been around for 15 years. So the only parallel that you want to look at is, say, what has been around and how long has it taken for people to have a store of value? Store of value has been hundreds of years, so it's going to take a long time for Bitcoin to get to store of value. It's too volatile for it to be a store of value right away, anytime soon, right? Okay, what about transaction? Well, the gas fees on Ethereum or the cost of mining Bitcoin, Ethereum, and other transactions is still too high for you to have low gas fees, comparable to a Visa or a MasterCard at 2-3%. Or Visa, MasterCard, I think they're going to 5% next year. They already told all the merchants we're going to raise the fees, something like that. So even 5%, 5% I think is doable for Ethereum. Not sure with Bitcoin yet, but it is doable, right? So you could see it as a transaction mechanism doing fairly well. As a token of utility, it's still way too complicated for it to be a token of utility. So where would it go? You would expect it to eventually play itself out primarily in one of these three use cases, or a use case that we haven't even thought of so far, right? What are you using cryptocurrency for? Are you using a store value? Well, it's too volatile to do that. Are you using it for transaction? Well, the fees are too high. Are you using it for tokenization and for utility? Well, it's too complicated to do that. So let's just speculate on it. Okay, it'll continue. It could continue being a speculative instrument for quite a while until we eventually, like options. I mean, options are purely speculative. There is no inherent value in an option if you want to hold it forever, right? Because it's got a time value bound to it. So you're going to hold crypto as a speculative value for quite a bit of time until it loses its value. But right now, speculatively, it's doing fairly well. People seem happy with it.
Yeah. I'm happy with mine. Of course, I've been timing it, so I find that the crypto is, at least Bitcoin. I'm not trading smaller coins, much like you. I don't even hold Solana. I only have two. I only have Bitcoin and Ethereum right now. But I've found that Bitcoin's been a fairly easy asset to trade. Just even I think I've heard this from some other people, especially those who trade just off volatility swings and are carefully watching the liquidity, or even there's some people that are just keeping track of all the wallets and the whales moving. I'm still using Elliott wave theory, and I find that Bitcoin obeys like all the most basic rules. Still has fairly simplistic movements. The social signals are always, I think, telegraphed, and it's been amazing to trade, in my opinion. Yeah, it's been a lot of fun.
Yeah, absolutely.
Yeah. So when I kind of want to take a step back then, and I kind of want to ask when you're talk about what you do for teaching and stuff. When you're teaching traders, are you typically getting people who have some experience and have failed in that experience? Or you talked about working with professionals and kind of building that framework. How much of that not only plays into maybe the understanding of the technical and nomenclature involved with the practice, but also the psychology of money, and do you have a focus on that typically when you're also teaching people about trading investing?
70% of the folks that work with me are people that are doing it for a living. So they're professional, they have some experience, they have some gaps, and that's what I help focus them on. 30% of them tend to be, okay, they're mostly people that have had their career for a long time and now they want to move to a new career, and they decided the new career is making money off of the money they've already saved. So they're late career professionals. They're making a change in their career, if you will. They've said, okay, I've done technology for the longest time, or I've been a banker for the longest time, or I've been a restaurateur for the longest time. I'm 50 years old or 40 years old. The kids have gone out of the house. I don't want to go do this restaurant thing. I've got one guy who had a restaurant for 25 years, and then now I'm helping him get into trading to a large extent and walking him through step by step, right? For the last 6 months. So it's been a while since we've been doing it. So I think that's where I see 70% are people that are prop traders already. They have gaps, they have holes, mostly in psychology, but some of it also in just basic mechanics and making the same mistakes again, again, and again, right? So to try and get over the discipline habit. And 30% of them are just, I have money and I'm trying to find a way to be able to have the money make money without having to, do anything else outside of what I like to do. So that's where it's been most of my focus. If you will. I think the thing that is interesting to me is how many more people realize that day trading is not for them. meaning getting in and out of a account within minutes or seconds, P&L at the end of the day that they want to move on to, right? A lot of people I've found who seem to work with me are more of the, let's look at the P&L on a monthly basis. Let's look at the P&L on a quarterly basis, not necessarily on a daily basis.
Yeah. Oh, I found even when talking to I'm always surprised when talking when I find all the social medias and the interaction with them to be like completely different. Like my interactions with followers, for instance, on TikTok are so much different than those that I have on Twitter or YouTube. And when I talk to or make a video or some sort of content on TikTok, I am always shocked that so many people, when they even think of trading, they only think or they believe it to only be the few seconds in and out of a trade, or for some reason people are very aware of forex but not very aware of options or futures, which I'm not sure how what I perceive to be probably the most difficult way to trade to be the most like common. I'm not sure how that occurred. I've never forex traded. I have no interest though, but yeah, I find that to be not even that's not even my sweet spot. I was working full time and doing this on the side. I couldn't even have the time to be in and out of a position in a few seconds. And I think it's funny that you mentioned that your trades don't go more than 3 months, because for me, when I started, my sweet spot ended up being, as I was kind of like working down and getting more precise in my strategy, it ended up being about 20 days to about 3 months is the time horizon that I typically wanted for when I was setting up an options trade. So that I think that's really interesting. That is more of your focus, and what a lot of people are finding that would you typically say that is the more common, that people do not like being in and out of a trade in a few seconds, or the stereotypical version of day trading?
I think a lot of people find it, once they realize how stressful it is to day trade, sitting in front of the monitor all the time becomes a hard thing for a lot of people.
Yeah.
They'd rather make the trade, do whatever they have to do, come back in after 2 days, 3 days, 4 days, 5 days, a week, a couple of weeks, and then say, okay, has this gone up 7, 8%, 10%? Okay, I'm happy with it. Let me move on to the next one, right? They don't realize that day trading, like anything else, is a job, and you've got to be on top of the game. Whereas swing trading, there is a possibility for you to be able to focus on the right setup plays and do it for longer.
Yeah. Yeah. And there's a I don't know, I'm not trying to give away like free coaching and teaching, but do you find that there's a more measured practice that you can take when doing swing trading or long-term trading, when it comes to review of, because then you typically, I find when I'm swing trading, there's usually a fundamental aspect or a technical aspect, some sort of event. And so when I am looking back at my trade log, what failed, what worked, when I have a day trade, it's like entry was bad. When I have a swing trade, I'm like, this wasn't a good event idea. The fundamentals here were wrong. And then that allows me, that actually, I think that's where I have the higher win rate, is in my longer trades, because I have more inputs that I can look back and measure of like, was that a bad idea? What was the mistake in my thesis? And rather than just on a 1 minute chart, or 5 or 15, if you're day trading, there's only so many things that you can look back on. And sometimes the setup was great and it just doesn't work. It's just the nature of it. But I find, do you have a similar experience as well?
I agree with you 100%, right? I find it very hard to do. We used to call this in Amazon retrospective, which is looking back, right? Retrospective on minute trades are very hard. It's much easier, and the patterns and charting and technical analysis is a lot easier when you look at a longer time frame. So I typically tend to look at monthly charts, weekly charts, and daily charts, minute charts, hourly charts. I would view them, but I'm not going to go by them to a large extent. There are people who say that the same, I mean, at the end of the day, we know that technical analysis and charting is mostly fractal, right? So what happens in the extremely long term repeats itself in the short term, and the patterns repeat themselves in the even shorter term, and even they repeat themselves in the even shorter term, and so on and so forth. So very fractal in that sense. So you have the pattern and it just keeps repeating itself. But even then, finding the pattern that quickly enough, assessing and analyzing, requires you to train your brain to look for it very quickly, analyze it, assess it quickly, and act quickly. And that is a skill that takes time. It might take a year, it might take 2 years, but people that want to do day trading don't realize the amount of time, effort, energy, and the effort work that is required with the steep learning curve takes a year or 2 years. I mean, anything new I've started, if I've tried to be successful in it in less than 2 years, I've always set myself up for failure. So a lot of people lose patience expecting day trading to give them money within a week or 2 weeks or 2 months. I'm like, it's going to take, if you want to be good at day trading, you can. It takes 2 years. If you want to be good at anything, it takes 2 years. Why would you think it would take you less time doing this than anything else? Right? And the stories that people say, oh, I've heard this guy, he had $2 and now he's worth $1 million and he did it in 2 months. I'm like, dude, you have no clue what he actually did, how long he actually took, what all mistakes he made, how many stresses he had, and what she did to get to that point. So it's hard to be able to confirm that.
Yeah.
They forget that Wall Street exists and, the market's not just this enigmatic black box.
I agree. What you see on social media is very different than what people go through, right? There are a lot of times when you'd say, oh, I'm posting, a lot of people post just where they've been successful at and the good trades. Nearly 45% of my trades are just lousy trades. I've lost money. But the reason why you do okay is because 55% of the trades you position size well to let the winners win a little bit more than the 45% of the times you're lost. So you're wrong a lot. 45% is nearly half the time you're wrong. Right?
Yeah.
I
also think I have in the past though also gotten some criticisms and some feedback. What Twitter is. People will lash out at you. It's usually not anything in particular you did. They're just mad at themselves usually. But it is what I find. But I've got criticisms for not sharing more of my bad trades. And every once in a while I will, if I'm including some sort of lesson. But I also find that when people are new, they tend to focus too much on the bad trades. And you need to have a positive mindset and always be looking if you really want the success here. And so for me, often I'll make a note of a lesson that needs to be learned or a mistake that was made, just so I don't become negligent or, to it. But I find that if you got to stay positive, you got to focus on the winners, just like you would when you're actually trading. Cut the losers fast, be tough on them, let the winners run. Would you find that is typically a good headspace to keep stay in for your mental?
I agree with you 100% on everything that you said, right? If you're not in the market thinking it is going to go up at any period of time, don't be in it, right? Number one, you've got to be optimistic about it. That doesn't mean taking useless bets. So I have three, basic tenets that I follow every single time. I always understand that number one, the market is designed to go up in the long term. Yeah. So if you have a bearish view for too long a period of time, you're just wrong. The market is designed to go up. That's the whole point of the market. So if you look at it over a longer period of time, yes, number one. Number two, if you don't have any differentiating capability that helps you understand why you know something more different than somebody else knows, then you might as well put money in an ETF. Right? In my case, what that means is if I don't know the technology space and why Klaviyo, I believe, will do better than a Sprout Social, given their different markets, even though they're in the CRM space and both of them are SaaS companies with comparable kind of margins, I should just buy a SaaS ETF and stick to it. Right? If you don't know something that differentiates why one versus the other stock is going to do well, don't be in that space. Go do something else. Right? That's number two tenet. Right? Wise. And then three tenet, so markets are always designed to go up. you need to have something that helps you be different. What is some people call it the edge, whether it's a trader's edge, investor's edge, whatever it is, something has to differentiate why you are able to pick a winner and how that has been proven over time than somebody else's, right? That's my second tenet that I follow on a consistent basis, right? And the third tenet is, if all else is equal, if it is a 50% chance of X versus Y, don't do it. I don't want 50% bets. I do not want 50% bets. Unless it's 65% or 60% and higher that I'm going to win, I'll just be in cash, right? From August 4th, I've been in cash. 80%, now it's close to 90% cash. I see the market going like this and maybe down a little bit more from here, but I don't see it going up. Why would I do anything? I'd be in cash.
That's so smart. And
Absolutely.
I only hear that from people with extensive time in this, is the patience of when you have the experience, you could just sit and wait, and you don't have to make a move. You don't have to trade. I find that new people always feel the pressure to thinking that day trading means that you must trade every day, or rather than have the patience to wait for when the stars align, when it is obvious to you. Because once you've developed that experience, you're going to see those opportunities so much clearer the more time you have in the game. And you don't have to make a move until you see that opportunity. You see that high probability. You can just wait for that. And so there's a lot of wisdoms, but I think we're about an hour and a half in, or get close to that, Mukund. So I just want to say, where can people find you to learn more from you, to learn more from your teachings and your socials and stuff?
There are two primary places I focus on, Josh. I do a lot of work on Twitter, so I share whatever I want free. And then I have my website, mukundmohan.online, where I have a newsletter that I share with some of the subscribers. I've done it for quite a bit of time, right? So I've got subscribers since 2004. And they primarily tend to be people that have a day job, but they want to be able to do swing trades, and I share my opportunities and setups that I find the most useful. So whether it's on Twitter, I do share a lot on YouTube. I do a video every day just on my 5-step process to help people understand, okay, go through these set of steps every single day with different stocks and form a hypothesis on where things end up, right? I do that almost every day on YouTube video. But otherwise, you can find me online. Mukundmohan.online is probably the best place to be able to see more of the work that I do.
Well, thank you so much, Mukund. I also want to just say that anyone visiting his Twitter, he has tons of helpful free links and different services he uses, and not only just learning tools as well that are free, not even included in his course. And I love to see that. I've watched your YouTube videos as well, and I enjoy those. And I am very flattered and honored to hear that you might have watched a few of mine as well.
Yeah, no, absolutely.
Yeah.
Thank you, Josh. Thank you so much. I do pop into the Discord once in a while, but I typically tend not to use Discord a lot. So once in a while I'll pop in and say, "Hey, Josh, thank you for the sim," again and again, or something like that.
Yeah.
But it was terrific talking to you guys. Thank you so much, Monty. It was great talking to you as well. Maybe next time we do a podcast, or we do a YouTube video on helping me understand the kind of exercise routines you guys have. That might be an interesting.
Yeah.
Is that the growth or the gain side of the podcast?
Yes, exactly.
One of them.
Yeah. Absolutely.
Thank you guys so much.
Thank you for coming on. It was great talking.
Okay, let's see you again. Have a great one, guys.